Hello, I'm Nathan Kubik, and thank you for joining us for the 2022 year-end Transform Wealth Capital Markets Review. I hope you are all doing well. It was certainly a challenging past year, and we have a lot to discuss about 2022 and moving forward into 2023. Today, we will be discussing the continued volatility, what's driving that volatility, as well as the key influencing factors moving forward. After a discussion on potential impacts from those factors, we'll expand upon how we're positioned from an investment standpoint in a number of our strategies. So let's get started. The most critical factor in the markets remains that of inflation, which has proved stickier than we might have hoped. The Fed ended up hiking rates 7 times in 2022 and has indicated an additional hike to come. While it does appear that core inflation growth likely peaked this past year, the timing of getting inflation under control remains an unknown. Corporate earnings have remained resilient, and it appears that most companies are weathering the current environment pretty well. We are also seeing some tactical corporate moves to reposition as we move forward. This will be another key quarter to watch the earnings releases and, more importantly, hear their forecasts going forward. Market valuations are currently just below their historical 25-year average. Given the current earnings forecasts, along with the various possibilities of a soft or hard landing, we find this level to be relatively appropriate. In short, if we do experience a soft landing, the markets are probably a bit undervalued. But if there is a hard landing, the markets would currently be overvalued. As you will see in each of our strategies, we are positioned with this in mind. 2022 was a particularly tough year for investors, with both stocks and bonds being hurt by the Fed's actions to combat inflation. Here, we consider the performance of a 60% stock and 40% bond portfolio. As you can see, it is a rare occurrence to see both stocks and bonds down at the same point, with this being only the third time this has happened in the last 70 years. Of course, this is all driven by the inflationary environment caused by the aftermath of the economic shutdown from COVID and the corresponding stimulus and resulting factors that have caused the Fed to raise rates. On a positive note, we are seeing signs of inflation growth coming back down. The chart on the left looks at inflation on a year-over-year basis. It is important to make the distinction that here, we are looking at Consumer Price Index, or CPI levels, compared to that of a year ago when CPI levels were lower. This is not looking at the change month over month. As you can see, inflation does appear to be moving back down, albeit not that quickly. And while the National Bureau of Economic Research has not yet called this an official recession, we did see negative GDP growth in the first 2 quarters of 2022. Which turned back positive in the third quarter and is forecast to be even higher in the fourth quarter. That, along with okay manufacturing, industrial production, retail sales, job market strength, and continued corporate growth, imply further that the possibility of a soft landing is possible. That said, we're not out of the woods yet, and it's important to remain positioned more thoughtfully until more clarity is gained. When looking at supply chain delays, much of these concerns have abated. Looking at the chart on the left, we see that delivery times for global PMI suppliers have indeed moved back towards more normative levels. And when considering input and output prices in the chart on the right, we are seeing those moving in the right direction as well. But at the heart of the inflationary issue is that of the labor markets. Unemployment levels are at record lows, and wage growth had become a concerning factor. This is a key factor the Federal Reserve is watching. Wage growth is a meaningful factor when considering inflation, and here we see that it may have peaked last year. When it comes to employment, we are in a strange period of time, a time where the equity markets are wanting to see higher levels of unemployment, or at least that wage growth has moved back down. But at the same time, we just saw 5 million retirees leave the market over the last couple of years, which makes it more difficult for companies to lay off employees or attract new employees at lower wages. We are seeing job openings relative to job seekers begin to decline. This is a good thing, but there are still 1.72 job openings for every person looking for a job. We are also seeing people quitting their jobs beginning to slow down as well. And while these indicators are starting to trend in the right direction, there is still a long way to go. Ultimately, it is likely going to take some time to get these metrics where the Fed needs them to be. Interestingly, the consumer has remained resilient this past year, and consumer spending remains elevated. If this pattern continues, it will take longer to bring inflation down, but it also could make it easier for the Fed to fine-tune a soft landing. Of course, a major shift in spending patterns could make it more difficult for the Fed to navigate successfully. Here, on the chart on the left, we consider consumer sentiment. Over the last quarter, we have seen the consumer's outlook become slightly more optimistic, and we moved off the 50-year low experienced in the third quarter last year. That said, we are still at incredibly low levels that would typically correspond to less consumer spending. But as you can see in the lower right chart, consumers have been working through the excess savings created during COVID, while still maintaining relatively healthy balance sheets of their own. Ultimately, this information is also being closely monitored by the Fed. Remember that the Fed is looking to slow consumer discretionary spending in order to get inflation to move down, but not to do it too dramatically that they cause a recession. Keeping these factors balanced will be key in whether or not the Fed is successful, and these past few slides really depict the major factors driving market valuations today. When considering the U.S. equity market, as well as that of the rest of the world, the S&P 500 was down 19% for the calendar year 2022. The rest of the world was off pretty close to the same. U.S. market valuations were high moving into 2022, while much of the rest of the world were trading at lower valuations due to lower expected growth forecasts. However, much of the rest of the world has been impacted more dramatically by the world's inflation, and areas like Europe have been impacted more dramatically from the Ukraine-Russia war. Ultimately, we have remained invested domestically, and at the moment believe greater headwinds are facing the rest of the developed world. That said, we are closely monitoring any indications that that could shift, as international valuation metrics are meaningfully lower than that of the US. And while we do not expect meaningful international growth, should that shift occur, we are positioned to tactically shift some of our geographic exposures as well. Looking at this chart, we see the historical annual returns of the S&P 500 depicted in gray, and the max decline within that year depicted in red. Forecasting 2023 is difficult, especially considering the unknown timing it will take to bring inflation down. And while historical performances following a meaningful decline are not indicative of future results, we thought this paints a good picture of what's happened in some past windows in time. It's also important to remember the COVID rally, which did occur long before the economy had any meaningful recovery. I mention this because at some point, the market will again begin pricing to the future. And while forecasting equity market performance is difficult in times of uncertainty, here we consider the consensus of analysts' estimates of earnings of the S&P 500 constituents. As depicted in the chart on the left with the blue lines, we can see that there is an estimated decline in earnings for the calendar year of 2022. Much of this comes as a direct impact from higher input costs due to inflation. But higher interest rates are also a factor. While 2022 did decline slightly, the consensus is forecasting greater earnings in both 23 and 24 on a trajectory similar to what was expected at the beginning of this inflationary period. Should this prove true, the equity markets should benefit from such a result. Moving into equity market valuations, the S&P 500 forward price to earnings ratio is just below its historical 25-year average. Given the current earnings forecasts, as we just discussed, Along with the various possibilities of a soft or hard landing, we find this level to be relatively appropriate. In short, if we do experience a soft landing and earnings forecasts are realized, then the markets are probably a bit undervalued today. However, if there is a hard landing, then earnings forecasts are likely inflated and market values today would be overvalued. We are optimistic that a soft landing can be achieved, but that it is too early to completely position for that eventuality. To that end, we have positioned our equity strategies with the intention of minimizing our exposures to companies we believe have the greatest downside risk in that scenario, and we are also using specific investment vehicles to dampen our overall market downside risk exposure while still maintaining upside risk exposure. Prior to 2022, the equity markets have been led by the growth side of the style equation. This role reversed in 2022, with a flight to large value companies. From a longer term perspective, this is the shift that one would expect to see in a scenario with the risk of a recession. And we did shift away from our growth tilt in the first and second quarter of the year. The spread in performance did tighten in the rally that we saw in the third quarter, but regained its differential in this last quarter. It's also important to keep in mind that there are different sub-styles within each style box, and that those also perform differently in these different market cycles. Currently, we are a bit tilted towards growth. However, we are looking for very specific characteristics for companies within each of these style boxes. Over the past few quarters, we've discussed our focus on GARP companies, or companies with growth at a reasonable price. These could be companies that end up in the growth, blend, or value style boxes that show growth characteristics that aren't overly expensive when it comes to valuation. We do expect some continued volatility ahead, and we find these companies to offer the most attractive risk-return ratio going forward. Lastly, in each of our equity strategies, we have defensive hedge strategies in place with the intention of dampening volatility. We will look to these hedge strategies as a source of cash for future deployment when we determine it appropriate to add some risk back to the portfolio. From a sector standpoint, our largest overweights are in financials, healthcare, consumer staples, and consumer discretionaries. Our current underweights are in communication services, utilities, and real estate. Right now, energy is being affected by a number of things around the world, and we are maintaining our slight overweight exposure here. On a relative basis, for the year to date, more value-oriented sectors like consumer staples and utilities have continued to perform. That said, we do expect these sectors to lag as the market cycle begins to shift. While we do not believe we are there yet, as economic and market conditions improve, you will begin to see some incremental shifts to position for the eventual recovery. Here, we consider our current weights within our core equity model. This quarter, we did make some moves in order to capture some losses for tax purposes where appropriate. We also took advantage of some individual companies' price movements to add some new holdings that looked relatively more attractive from a valuation standpoint. As you can see, we remain relatively defensive from a sector standpoint, and we feel our underlying holdings are well positioned for what comes next. We are continuing to tweak our exposures as we continue to fine-tune this model based on changing market conditions and are well positioned to shift more meaningfully as more indicators emerge. The dividend model remained well positioned for this past quarter. This strategy has an inherent tilt towards large cap value and the more value-oriented sectors, which has boded well for this model throughout 2022. This model has focused on underlying value companies with growth characteristics, which resulted in stronger relative performance. Additionally, like the core equity model, we also continue to hold a defensive portion within this model to hedge strategies as well. We are also aware of the implications of inflation and potentially rising interest rates on dividend-paying companies and are thoughtfully positioned with this in mind. Moving into the bond side of things, we have seen the largest intra-year decline in bond prices in the last 50 years. Again, this was driven by the Fed raising interest rates, and we were positioned with the possibility of higher interest rates in mind. This chart represents the entire U.S. bond market, and as you can see, at quarter end, the U.S. bond market was down 13%, up slightly from its intra-year decline of 17%. For a couple of years leading up to 2022, we have been discussing our positioning with you and why we believed it critical to reduce our interest rate exposure by owning shorter, lower duration types of bonds. And while all bonds have gone down in value, the degree to how much is incredibly impactful, and it has given us the opportunity to now buy bonds with a much higher yield going forward. This past quarter, with the 2 additional rate hikes, we saw yields moving further upwards. Having been positioned shorter and now moving out the curve a bit, this will further benefit our clients in the long run. Yields 1 year ago, as seen in the gray line, there was minimal upside in yield for extending our portfolio duration, and there was too much corresponding interest rate risk associated with such a move. Now that this risk return profile has shifted and our clients have been rewarded with less downside exposure, we have shifted some of our portfolio durations to reposition for this new interest rate environment. We are still not being overly aggressive here, as rates can move higher, but it does appear as though the current scheduled interest rate hikes are already priced into the yield curve. As the rate hike cycle moves to an end, it is our intention to move out further in duration, locking in these higher yields for a longer period of time. But we are not there yet, so stay tuned. This chart shows us where the Fed funds rate is today and where it is projected to go. The gray square at 4.38% is where we are today. As you can see, the markets are expecting one more rate hike to a 4.59% and then dropping back down a bit going forward. The Fed's latest projections are at a higher level, but not that meaningful of a disparity. If the markets and the Fed are correct, this is supportive of our current positioning, and it implies that we will be reaching the targeted levels within the next expected rate hike with a possible small follow-on hike. Looking at the entire yield curve, much of this appears to be priced into the current bond market prices and yields. Another meaningful piece of information is that the Federal Reserve balance sheet is tightening, and they are actively selling bonds that they purchased over the past few years. They did the purchasing to normalize the bond market during COVID and are now in the process of unwinding some of these holdings. The reason this is meaningful is that their selling increases the supply of bonds in the market. This increased supply has the impact of pushing prices down and yields up. Thus, even after they decide to stop raising rates, they will still be influencing bond prices on the supply-demand side of things. This, combined with the likelihood of some continued volatility, makes us believe that we have some time to lock in higher yields for the longer periods of time. As a result, we expect to be able to be patient. This ability will allow us to incrementally move out the curve with our bond holdings as more information becomes available. Lastly, we wanted to show you the changes in yields in different types of bonds and different levels of durations. Looking at the top portion of this chart, we see the significant increase in yields. Having owned shorter duration bonds throughout this rate hiking cycle has resulted in a much milder decline on our bond values than that of the entire market. Those declines can be seen in the middle part of the chart, and now we can turn around and purchase a bit longer bonds, locking in these higher yields for longer periods in time. This is one of the silver linings seen through this market cycle, and one that will be beneficial in the long run for our clients. So in conclusion, given all available indicators and economic data, we continue to feel well positioned in each of our strategies. While it is likely we will continue to witness some volatility as we move forward, we feel strongly about the companies we currently own and the way that we are positioned going into the new year. We remain focused on potential risk exposures and are prepared to reposition should indicators shift further one way or another. Know that we are watching the markets and your holdings incredibly closely. We are continuing to position your portfolios in efforts to reduce our perceived downside risk exposures with the intention of maximizing your risk-adjusted returns. As always, thank you for placing your trust in us, and please reach out to us if we can provide you with any additional information or clarity on the information presented today. Take care, and we look forward to speaking with you soon.